Finally, the market's behaving like you expect when the Fed is your friend. And as I told you at the top of the show, believe me, there are few things more friendly than a 50 basis point rate cut. I've told you over and over again that there are discrete phases in the business cycle. When the Fed is your enemy, when it's raising interest rates, you want to stick with the recession-proof stocks of companies that can produce consistent earnings even in a slowdown. Then once the Fed's done tightening and we start seeing signs of impending rate cuts, you need to load up on the cyclicals, the companies that can see massive earnings growth when the economy accelerates. But what works best once the rate cuts have already started? Yesterday, Sailorman and the CNBC Pro team ran an analysis of which stocks in the S&P 500 tend to perform best over the 3 months after the Fed starts easing. I like this piece. Going back to 1984, they identified 10 stocks with the highest median performance after the first rate cut. And it is really a surprising list. Get this. Western Digital, Lam Research, United Health Group, Expeditors International, Apple, Kroger, Textron, Franklin Resources, Amgen, and Target. Surprising amount of tech in there, too. Surprising amount of healthcare. So let's go through them one by one, because I think it's important to learn from history, whether or not that history ends up being repeated or not. First, Western Dig is up over 20% on average in the 3 months following the first rate cut. This maker of hard drives and solid-state drives, basically storage for your phone or your PC, has historically been, sadly, a giant value trap. Just a trap. Right now, we're seeing an uptick in demand for storage as part of the AI data center theme. But if you want to bet on that, you know what? Why don't you go with the down-and-out Micron? It's much better operators. Pull back dramatically. Reports real soon. A lot of people have written it off. Second, Lam Research is a key semiconductor capital equipment maker. Right now, they're being suppressed by a lack of Chinese orders, not to mention Intel slowing its European manufacturing plants in order to preserve its balance sheet. Wise. If not for those issues, I think it'd be a great buy right now. But given that the industry's got problems, I say let it come in even more, but Lam is the best in the group. Third, United Health. Unusual rate cut winner. In theory, it should be more of a slowdown stock. But empirically, it's done very well when the Fed starts cutting rates. UNH is a terrific operator that's been pulling away from the rest of the managed care space, but I wouldn't recommend buying it right here unless you think the Fed's desperately cutting rates because the economy's falling apart. Then you buy UNH. I don't see that happening. Fourth is Expeditors International of Washington. Now, this is a pure logistics play, but in my opinion, it's a poor man's FedEx and will trade off because FedEx tonight is tumbling in after-hours trading after reporting kind of a bad miss in cutting its full-year forecast. Bummer. Right now, ocean freight rates are high. Yemen keeps disrupting shipping in the Red Sea. But if we ever get some stability in the Middle East that goes, well, it goes away, maybe I can make a case for Expeditors. Hard to recommend, though. Fifth, Cramer fave Apple. I always say own it, don't trade it, and I'm extra adamant about that position after what we heard from T-Mobile's Mike Sievert yesterday. Contrary to what the Bears have been telling you, Sievert says sales of the new iPhone are going just great. I want you to listen to what he told me last night.
This is another year of great phone introductions.
You're telling me the first week's been good for you.
The first week was better than last year. And so not only good, but better than last year. And people are buying Pros, they're buying Maxes, so they're buying up the food chain, and they're buying at a greater rate than last year. Now, what's interesting is we may actually see that this is better than last year to a slightly greater extent, because I have a feeling this cycle will be lengthened a little.
Man, I love truth. Truth's good. Now, I'll more on Apple later. You just need to know that this is our #1 name, despite endless sources trying to shake you out of this one. This is still a technological marvel, for heaven's sake. Six, there's Kroger. Now, I've been amazed at their ability to run a tight ship, even while fighting with the FTC to get that Albertsons merger done. Last week, Kroger reported a real good quarter, but with Albertsons deal languishing, I think it puts a lid on the stock. That is so unfortunate, because I like it very much. Seventh best performer when the Fed starts using Textron. Huh? Intriguing industrial. They got autos, they got defense, they got business jets, think Cessna. I think it could work now if the Fed's cutting rates, but keep in mind, Textron will get clobbered if the economy's truly in much worse shape than we think. Number 8 is Franklin Templeton. It's an asset management story, but one of its subsidiaries is being investigated by both the SEC and the Justice Department. Suboptimal. Last month, its longtime chief investment officer, who managed some of the largest bond funds in America, took a leave of absence after getting hit with a Wells notice from the SEC. In the end, it's rarely a good idea to own stock in a company that's under investigation, especially when the Justice Department's involved, too. I don't think you can touch this one. I think this is what the kids mean when they say that the vibe is off, something that doesn't really feel right. To me, vibe off means that I've got it on ringer. Ninth, there's Amgen, which could be good this time, but I hesitate to recommend a drug stock right before a presidential election. Democrats are always tough on drug prices, and frankly, neither candidate loves this industry. Plus, if you want a drug stock, you know what? At this point, just go for a big dividend. It comes a little more enticing as rates come down. Finally, there's Target. Now, this one makes a ton of sense to me. Of course, Target wins when the Fed starts easing. On top of that, it's got a terrific turnaround story. The company just reported its first positive same-store sales growth since 2022, driven by higher traffic, not higher prices. Thank you, Brian Cornell. I think Target's doing a lot of things right, controlling costs, growing margins, stopping theft, and cutting prices to bring back customers. On top of that, they're taking share on the digital side. When it comes to retail, I think there's room for Target, along with Amazon, Walmart, and Costco, along my other favorites. Plus, it's got a 3% yield. So here's the bottom line. Now that the Fed started cutting rates with a bang, you need to think about what kind of stocks will work best in what I consider to be a new regime. Our friends at CNBC Pro got you started with the 10 stocks that done best during the first 3 months after rate cut, going back to 84. But when you go through their current circumstances, the only ones I can fully endorse are Apple, Target, and Textron in that order. I feel in a call mood. Let's talk to Lane in New York. Lane.
Hey, the doctor of Cramology, Jimmy, baby, what's going on?
Not much. What's shaking with you, partner?
Hey, let me throw something at you. I was talking to one of my buddies. I'm a mailman. So
okay.
I have the UPS stock. So by what I hear, that is an up and down stock. So they are just landed a huge contract by the USPS to deliver all the mail. So is that a good growth stock, or should I, even though with that happening, should I go to FedEx or another?
Okay, here's the problem. FedEx reported a number that is weaker today. We've got to see how UPS acts off that. UPS has been holding well. Why? Because it's got a 5% yield. And I think that's what's really going for it. Pay 5% while you wait for a turnaround, but we don't have a turnaround in sight. Let's see what FedEx has to say, and we'll know more then. Let's go to Richard in Michigan. Richard!
Oh, that's nice. Yeah, Richard from Michigan. Hope you're having a great time in San Francisco, Mr. Cramer.
I love it here. I love it here. Frankly, it's like, I mean, it's sensational. I just love it. What's going on?
Before, love it. I'm a charter member in an investing club, and
thank you.
I'm at an age where I'm trying to reduce volatility and add some diversification in my portfolio. I have a stock that I've never been in the industry before. It has a PE of 10, forward PE of 10.6. With the half-point reduction in Fed funds and mortgage rates trending lower, what's your feeling about a trade-up stock like Toll Brothers?
Okay, I hear. Look, I like Toll, and everybody knows I like Toll. Interviewed Doug Yearley not that long ago. I mean, a week ago. I think you're doing well, but Lennar reported tonight, and people don't like Lennar, so Toll will probably be down. We're going to have to take a hard look at how low it goes, but I do like Toll, and I do like Toll more than Lennar. All right, now that the Fed started this cutting cycle, I think Apple, Target, and Textron, TXT, are the stocks that will benefit the most. I can't believe I just said something good about Textron. It's been a decade. But I have to endorse it. Much more Mad Money ahead from San Francisco. Darden Restaurants popped over 8% today after earnings. I'm thinking the important new collaboration helps see what's cooking there. Hey, by the way, their steak place has great Bloody Marys. And T-Mobile, unsolicited but still good advice. And T-Mobile's top brass revealed the sales that he's been seeing for the new iPhone 16 models. We got to take an even closer look at what people try to do to get you out of Apple stock. I don't think they like you. But first, don't miss my exclusive with CEO of CrowdStrike, who's now buddying with Microsoft. Anything can happen, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.